Well, hi everyone. Welcome to the Buffett and Beyond Research introduction video to the stock selection method called Clean Surplus. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And part one, introduction to clean surplus. Well, what is it? The methodology is derived from clean surplus. Actually, it was clean surplus accounting. And Warren Buffett did not develop this method, and the original formula came from the accounting profession. But we know that Warren Buffett used this method with great success when he bought exchange-traded stocks. And clean stands for standardizing the returns of a company. In other words, delete all the non-comparable items between U.S. Steel and Amazon and Google. And that's what the clean stands for, because those non-recurring items that are in there are not comparable from one company to another. Surplus stands for profits. So we're going to talk about the profits of a company, but in a clean surplus methodology. And it is clean surplus that allows us to compare the return on equity ratio, or the ROE as we all know it. Now, does it really work? Well, our returns are among the very best in the industry. And note, our portfolio is not traded. It's buy and hold for as long as the stock meets our criteria. Sometimes it's a year, sometimes it's many years. And changes, if any, and usually there's about 5 or 6 changes each year out of 30 stocks. So changes, and if any, and rebalancing are made on the last trading day of each year, and most of the stocks are large cap stocks. Now look at the returns since 2002, and our portfolio on average has returned 17.1% a year, S&P 10.4%, and Buffett 11.9%. When you compound those returns, we're looking at serious differences here, folks. Our portfolio up almost 2,000% on a compounded basis since 2002. Now, our growth model, again, is buy and hold with changes, if any, taking place on the last trading day of the year. Usually we do it between Christmas and New Year's when the market's not doing anything. And the portfolio is made up of large cap growth stocks, and these results do not include hedging, because we have a whole hedging technique we're not getting into here, but we'll talk about in other videos. Now, Buffett and Beyond Accounting course was registered with the National Association of State Boards of Accountancy as a quality assurance service sponsor of continuing professional education credits for accountants. It was a 10-credit course. The state of Florida also approved it as a lecture to be given to accountants. It was a 2-hour and 40 minutes or so, and it was approved for accounting and auditing, 2 credits. So you can see that there's a lot of research behind this, and it is an accepted method, except nobody uses it for, stock selection like we do. Okay, what is clean surplus? How is it used? It is an accounting statement that allows for predictability and comparability. Predictability is the key, but you have to have comparability, so you can compare NVIDIA with Amazon, with FICO, with any other stock in any other industry, and that's what's so important. So let's take a quick look at the accounting statement. We have revenues, and then we take away all the recurring expenses, cost of goods sold, selling and general administrative expenses, depreciation, interest, and taxes, and that gives us something called net income. Now from there, we take away the non-recurring items, and these are expenses we cannot foresee, and they're not predictable. That's why they're non-recurring. And I always, when I give a seminar, I always use an example, our own private income statements for our household. A non-recurring item would be, hey, you paid for the state college education of little Susie, and she grows up and she says, I don't want to go in state. I just fell in love and I want to go with my boyfriend out of state. Well, that will put a dent in your net income, won't it? So it's these kinds of things. who owns in a company. We're talking about who owns the Rolls Royce, and was the building of your house, the president's house, used as an expense in the company. So we take away these non-recurring items, many of which are found in, the footnotes. And how about those options that are given to attract people in higher positions, or somebody that's you have to compete for, that's also trying to be hired by another company? That's down in here also. So after all of that, we come out with earnings minus dividends, and it comes over here to book value or owner's equity. And let me tell you a little story about General Motors. Now, in 1991, it had a book value of $42.89. And then FASB, the Financial Accounting Standards Board, came along and said, hey, Mr. GM, you have not allocated any expenses for the medical and retirement expenses of your present workers. And GM says, well, how do we do that? And they said, well, there's three ways to do it. One is you can take it that expense 1/20th per year over the next 20 years. And General Motors says, well, that's going to affect our earnings for the next 20 years. And then FASB said, well, you can take it all at once. And General Motors says, what's the third thing? And nobody seems to remember what the third thing was. But what they did is decided to take it all at once. So here we are, Times Square, midnight, 5, 4, 3, 2, 1. And at the stroke of midnight, the book value of one of the largest companies in the world at that time went from $42.89 per share to $8.47 a share. So if you're an analyst and you're using a return on equity, you had something that you woke up to on that next morning of 1992, and you were a little confused about what was going on. Now, it didn't happen at the stroke of midnight on 1991 going into 1992, but it did happen at the stroke of an accountant's pencil. And this devaluation was due to an accounting change. Nothing in the company had changed. This was a non-predictable event. Okay, so if we are using net income as our earnings for clean surplus and not the earnings, because the earnings are distorted for each individual company. One company, now Merck or Pfizer did not have to allow for that accounting change between 91 and 92. So how could we compare General Motors to any one of those companies? So when we look at the income statement, we take earnings minus any dividends, and we bring it over here to the balance sheet. What's the book value or owner's equity? Well, if we are using clean surplus accounting and we're using net income as our earnings number, because we are trying to get rid of these non-recurring items because they are not predictable and do not allow for predictability. So we take the net income minus the dividends, because dividends are a cash payment out to the investors. We take net income minus dividends and bring it over to the balance sheet. Well, you can see right away you have two different book values or owner's equity depending on which type of accounting you use. All right, let's talk about the return on equity. Most widely used comparison ratio for security valuation, not the PE ratio. Do not get me started on the PE ratio. That's a whole nother video, and it's in my book, and it will be a whole chapter in the next issue of the book that I write. Now, the ROE is an operating efficiency ratio, or we think of it that way. Problem is, everybody uses the wrong return on equity. They use traditional accounting return on equity. And there it is right there. Traditional accounting return on equity is this one down here. But folks, to get to this earnings number, it's not comparable because these non-recurring items up here do not allow for predictability. So we have to come up with this net income, and net income is used differently. On the accounting sheets, you have to be very, very careful there. So net income minus dividend comes over here, and guess what? Now we have to change the book value. So we're changing two things in clean surplus. How do we know that everyone uses the wrong ROE? Well, in any one year, just 25% of professional money managers outperform the S&P 500. In the following year, just 1/3 of that 25%, or 8.25% can outperform the averages 2 years in a row. But over any 10-year period, and folks, this is a Morningstar June 2002 report, over any 10-year period, 96% of professional money managers who run the publicly traded mutual funds cannot outperform the averages on the risk-adjusted basis. Now, how do we find the correct numbers? Well, we have a computer program. The reason I'm laughing is we have a computer program that does it for us. And the thing is, the computer program was made from data sheets of 22 students that I had when I was teaching portfolio management. And it was a 2-semester course, so it's 8 months. So 22 students and myself, 23 of us, took the time to analyze the S&P 500 stocks. That's how long it takes, because you have to go back and you have to find an original clean surplus book value from which to start your numbers. And we're going to show that in a minute. Now, let's look at IBM. And here's traditional accounting return on IBM. And we can see, wow, some years we have a 53%, some years a 64%. Think about this, folks. If you had a company, or you were buying into a company, or thinking about it, and a company had a 64% return on equity, you would go out and buy that stock. You would mortgage your house to buy that stock. But the clean surplus return on equity is a lot different, isn't it? Totally different. In fact, the average stock has a clean surplus return on equity of 13 to 14%, depending on which year it is. So we're looking at IBM that has less of a clean surplus ROE than does the average stock. Using the clean surplus method, we would expect IBM to have a lower return than the average stock. In other words, we're saying it's a dog, it's a dog, it's a dog. Do not buy IBM. Traditional accounting ROE says buy. Now let's look at the last 10 years. Black line is the S&P 500. Yeah, and this mustard colored line is IBM. So you can see that the market, as measured by the S&P 500, almost 4 times that of IBM. So you got to be very, very careful, folks, using a traditional accounting return on equity. Now, the published research. Let's go into some of the research that I had to do for my dissertation, because I went back to school for one reason only, and that was to study the stock market. That's the only reason I went back to school. I was already an engineer for 13 years, and I decided to go into the finance world, and I found out that nobody could outperform the S&P 500. I was good at protecting portfolios because I was good with numbers. So I was working with a group of people, and I was put in charge of hedging portfolios. Well, I did that pretty decent and came out very, very well during the stock market crash in 1987. But we could not outperform the S&P 500 in any traditional year. So the original research was published in a doctoral dissertation from Nova Southeastern University in 2002, and then a book was written in 2004, a second edition of the book in 2014, and the third edition will come out maybe next year. So the research focused on portfolios chosen from the S&P 500, and we compare the ROE of portfolios versus the ROE of the S&P 500 using the clean surplus methodology. The research was done over a 4-year period. So we took all the stocks and divided them up into portfolios of 30 stocks each. As you can see down here, 30 stocks each. We took all the stocks in the S&P 500 and sorted them from the highest ROEs to the lowest ROEs, and we formed portfolios of 30 stocks, and we'll show you why in a minute, and came up with 12 portfolios, and we said if these stocks have ROEs higher than the average of all the 500 stocks, they should outperform. And you can see here was the S&P 500. Over these 4 years of 1990 to 1994, the S&P returned on average 10%. All the portfolios predicted to outperform did outperform. Notice one caveat here is that we were not able to predict which of these portfolios of 30 stocks would be the best. So there was the just one little stickler in there. But all the research is, do portfolios made up of stocks with higher than average clean surplus ROEs outperform the stocks with the lower average clean surplus ROEs? And the answer is yes for these 4 years. Then we went to the next 4 years. Same thing. Market had a good 4-year run in there, returning an average of 28% per year. All the portfolios predicted to outperformed. Then we went another 4 years, and the market, dot-com bubble time, wasn't it, folks? And the average stock in the S&P 500, or I should say the S&P 500, averaged about a negative 7% return. All the portfolios predicted to outperform did outperform, and a funny thing happened is that they were all positive. So that was very nice to know. So we know that we're picking better than average stocks when we use the clean surplus ROE. Now, put them all together. Here they are in blocks of 4. So all those charts you just saw, here they are comprised. And here's what the S&P returned, and here's what the clean surplus stocks on average returned. So the clean surplus always outperformed the S&P 500 in those 3-4 year time periods. Now, we said, okay, how many stocks do you put in a portfolio? Why did I use 30 in that research? Because we found out, we did all research on stocks with 10 stocks in it, 30 stocks in it, and 50 stocks in it. So you can see that over the 4-year test period of 90 through 94, the first 4 years of test period, that the 10 stock portfolios did very, very well, but very, very erratic also. So some years it was not so good, other years it was fantastic. Now here's the S&P, what it returned, 10.4% over the first 4 years. All the portfolios outperformed the S&P 500, but the 30 stock portfolio was much more consistent in its return. And when you're talking about investors or even your own portfolio, you want more consistency than you want this 10 stock portfolio. We went also to 50 stock portfolios, which are not shown here, but the 50 stock portfolios start returning the amount of the S&P 500. In other words, they didn't perform as well as a 30 stock portfolio. So the ROE tells us all that we need to know about earnings. And we look for at least a 10-year summary of clean surplus accounting return on equity, a high return on equity, and a consistent return on equity. And how did we do over the past 22 years? So since that research, we started our portfolios in the beginning of 2003, and we didn't outperform every year, but most every year. And when you compound those returns over 22 years now, we're looking at seriously outperforming Buffett, and this blue line is the S&P 500. So we're looking at outperforming the S&P 500 almost 3-to-1 on a compounded basis over the past 22 years since the year 2002. So folks, you just learned something here. It was a brief overview of clean surplus accounting. It's complicated putting the numbers together, but if you think about it, it's a very, very simple concept once you have the numbers. And all you have to do at the end of the year, if you're using the computer program all year, you don't have to use it all year long, but we keep up on it on our side all year long. That's what we're here for. But you can take the list of stocks at the end of the year, and within 10 minutes you can pick your stock for the following year. All you have to do is look at the numbers. Forget about all the stuff that you hear. Unless a stock is doing something good out there, it will come to the bottom line, and we'll see that. So remember, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. Folks, we'll see you right on the other side. We've got more videos. We've got newsletters. So this is just the beginning of your education. Stay safe, folks. We'll see you right back here soon.